All right, welcome to Talk Tickers. Today, we are diving deep into the Q2 earnings report from Ethan Allen, that's ticker ETD. And this one's a real head scratcher. The company dropped its numbers, and honestly, they tell two completely different stories. You've got a big win on one side, but a major red flag on the other. So the real question is, which story did Wall Street believe? Let's break it all down. Right from the get-go, this earnings release felt like a classic tug of war. On the one hand, you could see their operational discipline just shining through. But on the other, there were these undeniable signs of a really tough consumer environment. This whole thing really set up the fundamental conflict for the quarter. So here are the two numbers at the heart of it all. On the left, you've got a solid earnings beat, 44 cents per share, which was way above what analysts were expecting. That's great. But on the right, you see a clear miss on revenue. They came in more than $2 million short. So the big question becomes, which one of these matters more? Is it the profitable bottom line or that shrinking top line?
Okay, let's start with the bear case, which is really all about that revenue miss. Because it wasn't just about what happened last quarter. The warning signs for what's coming were, frankly, even more alarming.
This is where the real problem is. You have to look at the pipeline for future sales. And whoa, written orders, which are literally the lifeblood of this business, they just fell off a cliff. Retail orders dropped almost 18%, and wholesale orders plunged over 19%. You can't spin those numbers. They're bad. So you might be asking, where did this massive drop in orders even come from? Well, it starts right at the very top of the sales funnel, an 11% decline in foot traffic to their design centers. It's pretty simple math, right? Fewer people walking in the door is going to mean fewer people placing orders. So how did management explain all this? Well, the CEO, Farooq Kathwari, he pointed to factors outside of their control. He blamed the government shutdown, saying it really hurt consumer confidence. He also made sure to remind everyone that they were up against some incredibly tough comparison numbers from the year before, which is fair. But look, that is only half the story. Let's flip the coin. The bull case is all about how, despite all those demand headwinds, the company's actual operational performance was incredibly strong. And check this out, a gross margin of nearly 61%. I mean, that's up 60 basis points from last year, even with lower sales. So how did they pull that off? Management pointed to a better sales mix, some headcount reductions, and a higher average ticket price. This shows they have some serious pricing power and fantastic cost control. And this right here is maybe the single best part of the bull case. Ethan Allen is sitting on an absolute fortress of a balance sheet. We're talking over $179 million in cash and investments. And, this is the crucial part, zero debt, not a penny. That gives them incredible flexibility to handle pretty much any economic storm and keep returning cash to their shareholders. Okay, so faced with this tough economy and all the pressure from tariffs, management didn't just sit back. They laid out a really clear game plan for how they're going to defend the business. Specifically on the tariff issue, they're using a three-pronged attack. First, they're working with their vendors to share some of that cost burden. Second, they're diversifying where they get their products from, moving to other countries. And third, they're pushing through some very targeted price increases, which they said averaged about 5%. It's a really proactive, smart defense. And internally, they're pulling a bunch of different levers at once. They're actually boosting their digital marketing spend to try and drive more traffic. At the same time, they're cutting headcount by over 5% to keep costs in check. And they kept hammering home a key strategic advantage they have. 75% of their manufacturing is right here in North America. So we have this fundamental conflict, right? You've got weak demand versus incredibly strong operational control. How in the world did investors weigh these two competing stories? So when the numbers finally hit the tape, what did the market focus on? Was it the impressive profitability and that rock-solid balance sheet, or was it that alarming drop in future orders? Well, Wall Street's verdict was swift, and it was decisive. The stock dropped nearly 7% in the very next trading session. The market clearly cared way more about the crumbling demand than it did about the strong margins. And look, this wasn't just a small move on a quiet day. The trading volume was about 4 times the daily average. That tells you there was real conviction from sellers. The market wasn't just a little concerned. It was actively and aggressively selling the news. So, knowing how the market reacted, what should we be watching for next quarter? Where do we go from here? For the bulls, the main thing to hang your hat on is a comment made about a positive order trend in January. If that holds up, it could signal that things are bottoming out.
There's also a wild card, a potential Supreme Court ruling that could get rid of certain tariffs. The bear case, though, is pretty simple. The big picture pressures on the consumer aren't going away, and those tough year-over-year comparisons are still in place. So, our prediction, you should probably expect that top-line pressure to continue. Now, their excellent margin management should provide a floor for profits, but the stock is going to be extremely sensitive to any new data we get on monthly order trends. That is the number to watch. Given this whole dynamic, we are initiating our coverage with a market perform rating. Look, Ethan Allen is a very well-run company with an undeniably fantastic balance sheet. However, all that strength is being canceled out right now by some major uncertainty in consumer demand. We believe the stock is probably going to trade in line with its sector until we get a much clearer picture of an order recovery.
This is not financial advice.